Welcome, ladies and gentlemen. Today is November 25th, Friday. It's the end of the week. We've had a nice Thanksgiving. Hopefully all of you had a great Thanksgiving and enjoyed. Took a little drive out today to see how shopping was, and it looked fairly moderate. Not quite what I expected, so be aware. I think a lot of people have decided to go online. I did as well, and do the bulk of my shopping online for the holidays and try to take advantage of what I want without having to actually stand in line and wait overnight like the old days. But we're going to go through the custom indexes right now and tell you what's going on, what to expect, and where I think I see the markets moving over the next couple of weeks into the holidays. We're starting out with the custom cash flow index. And remember, there have been some new indexes added here. I'm going to go over them, and I will be including some of them into the live trades, commentary, and charts. But understand that I continually do this research to try to help you understand what to expect in the markets. We still do not have a confirmed bullish trend in the rotational modeling system on the daily chart. We're very close to moving into bullish trending, and we could see a reversion. But let's go through these custom index charts, and I'll tell you what I expect to see happen. So right now in the cash flow index, we've seen a very deep recovery, kind of like after COVID here. And what we're looking at right now is a fairly strong recovery back up to 1.39, which looks very close to this area, which was a stall before the elections in mid to 2020. We have seen a fairly strong recovery from below these low levels that I talked about. The cash flow index indicates that we have broken this channel I've drawn here, and we are now attempting to break this channel on upward trending. So until we get above this upper blue channel here, there's a chance that the markets could roll over, could fail, could attempt to establish some new lower price level before attempting to move higher. And additionally, you have to be aware that we could see a bigger blowout to the downside, which could extend the downside risk here. So we have not yet cleared the threshold for solid bullish trending yet. We're getting closer to a recovery. We're getting closer to an upside move. We have seen a fairly strong upside move, but we are in no way, shape, or form, based on this chart, clearing any of these channels. We've cleared the first hurdle here. We've gotten above this high. We need to get above this high, which will put us above this channel over here in this 145 area, and that will likely prompt us back into a bullish trend, but we're not quite there yet. Okay, the next chart is the consumer engagement, and this is very, very telling in my opinion. We've seen this weaken back to the downside. Consumers are just not engaging in this rally. They are not buying into the rally. They're probably feeling the pinch of higher costs, higher credit costs. And so we're seeing consumers really weaken out of this trend. This is a monthly chart. And we need to see what happens here going forward. I would like to see this consumer index move back up into this 0.16, 0.17 area, obviously way up here. But until we get out of this downward cycle trend, without consumers, which make up close to 65-70% of GDP, we could have a very spotty recovery. So pay attention. No, if we do not see consumers pulling out of this and re-engaging with the market, the upside recovery may be waning, may be much slower than I had expected. Remember, back over here a couple months back, I was warning that we could see it rally back up into this area and see a nice deep V recovery. At this point, we might be seeing more of a waffling recovery into 2023 unless consumers really get back into it. And I don't think consumers are going to do that with the pressure put on it by the Fed and rising credit card costs and things of this nature. I think we're going to see more of an extended melt up instead of a big rally. Next, we have the large cap monthly index. Large cap monthly index is flattening out. You can see these cycle charts here that I've drawn. These are basically 1 year in length. Looking at this data down here in the bottom, a little bit less, probably about 11 2.5 months. But as you can see, I've highlighted the downward cycle trends with these red lines, and we're getting close to ending a downward cycle right now. So we could see the large cap index move back to an upside move. I'll draw these lines next week and extend them out to the right. But we could see this end of the downward cycle trend here over the next couple of months, January, February, really prompt some kind of a rollover, kind of like, well, more like this, kind of like a rollover to the upside, kind of like this, a rollover to the upside. And this is something that a lot of people are unaware of, is that large caps could turn into favor if the Fed suddenly becomes a bit more dovish, or if consumers and investors re-engage in the market in a broader scope, trying to buy these semi-depressed areas. So when you realize this is in an inverted chart, but the large cap index has moved down by, say, about 20-21%. So the large caps will continue to typically do well through an economic recovery, and we could see this large cap index move higher as we rotate upward and re-engage in 2023. Next, we have the global asset index monthly chart. Global assets are weakening still. They're trying to find some support. I mentioned to you how this original box, which I drew off of these highs and these lows here, needed to hold up. We're kind of testing this lower area. I'm thinking this is capitulation. Global assets are trying to find a bottom, and there is right now, in my opinion, a lot of traders dipping their toes into global assets, expecting some sort of recovery. But we still have issues going on globally. China is now in a lockdown again because of COVID. We have the Fed trying to battle inflation. Inflation is coming down. We need to see the global assets really form a bottom and start to move higher. Now, if you look, we've had a number of fairly strong 20% decreases, 20 to 24% decreases. This was 2000, the big collapse after the 9/11 attacks and the dot-com bubble. But in 2008, you can see here that it resulted in a fairly moderate decline in the global assets. And what's happened here is we've gone through a fairly moderate decline from about 60 to about 70, and that's about an 18-20% decline. And I would say that we're fairly close to kind of the same type of decline back over here in percentage terms. We need to see how this holds up, because I don't think it's going to go much lower, but we need to see if it forms some sort of an extended bottom before it starts to rally, or if it starts to rally into Q1 2023, which is more than likely going to be the case. Like maybe February, March, we might see this change direction and start to recover a bit. The custom gold cycle monthly chart is basing bottoming in accumulation. I'm going to show you again on a chart here in a bit, showing you my custom metals indexes and custom metal trend index. But this is very solid accumulation at these upper levels. Love this setup in gold right now. Really, gold and silver are accumulating off of the base levels. And this, as long as we stay in this area and don't really decline much, we're going to stay in this accumulation phase, kind of like back over here. So it's gone up, came back down, accumulated, tight little bars, and then we saw a rally phase that took place a bit. And this was a bit of a rally before it peaked. Remember, it peaked in 2012 and broke down. That's what we had here. Then we had this basing accumulation. Then we had a bit of an accumulation phase in 2015-16. Then we had a distribution phase. Sorry, is lacking the word. And then we based and started to accumulate again. This is a distribution phase. We've reached the low levels here. We've gone back into early stage accumulation. We do need to see accumulation move back higher. But again, folks, that may come over many, many months. So it could be kind of along the lines of a 6, 7, 8 month accumulation base before it starts to move higher. Once this really starts to move upward, this will be a big upward trend for gold and silver. the new custom market timing, or what I call the fear index. I've had a lot of people asking me about this. Brian, you're one of them. But long and short of it, I'm going to make this more available to you. We have moved back into a lack of fear mode here. This is an indication that we've gotten down below in a downward sloping channel. We've gotten down below the thresholds. We're nearing the lower threshold to move us back into upward trending, but we are, again, still waiting for that confirmation. You can almost see right across here, I'll try to draw a line, that we're just barely attempting to break above this channel. This is a do or die scenario for the S&P. This is the S&P up here, SPY, and for this, the VTI, which is the Vanguard Total Global Asset Index. We're getting near this breakout level. It's either going to go up and start to revert higher, or it's going to stall back out here and attempt to find something lower. This indicates that we are now at a very moderate lack of fear, meaning that we're not seeing any excess levels of fear. There's underlying fear in the markets, yes, but a lot of it has abated. A lot of it has mellowed back out. If this continues to trend lower and we continue to move higher, this will move us into a new upward trend. So because we are seeing this, this indicates that the traders are already planning and priced in what the Fed is going to do and what global markets can do. It would take a big event, some sort of a massive event, extended war in Ukraine, war with China, new pandemic outbreak, or some sort of a catastrophic financial crisis to send this skyrocketing higher. This is more along the edge of, we have experienced our event, we've waned back out of this event, now we need to see it either drop lower, which means it'll capitulate to the upside, the markets will, or with some other type of crisis event will come into the picture and we'll start to move back higher, which means we need to stay safely, comfortably away from risk. Okay? Right now it's looking positive, but we don't have a lot of confirmation of the upside yet. The consumer tech ratio index is moderately weaker month over month. We've seen lower lows this month. The month is almost over. I don't believe that technology is going to have a horrible year. For example, weaker technology companies are going to probably struggle. The stronger ones, Microsoft, Disney, which you're aware of, just replaced the CEO and brought back Bob Iger, Netflix, Amazon, the others. I think you're going to find for the most part that the undervalued technology sector is going to look very, very juicy over the next 6 to 12 months with these lower price levels. Yes, there's still some concern, but you need to understand these companies are still making billions of dollars every quarter with their assets the way they are, and are growing for the most part. So understand that this, we've already wiped out close to, if you figure this math, about 62%. We're back down into 2011, 12, 13 levels. I would not be surprised to see an early stage recovery in tech, possibly some moderate spending over the holidays, and continued growth. The technology sector is going to be around for quite a while, folks, and the technology companies can manage a downturn. I think prices have been overextended to the downside. We're looking at a capitulation bottom setting up. I don't believe it's going to get much lower. I mean, in reality, it could, but this would be an overextension of selling in technology, in my opinion. And I believe that it would, if it were to move lower, it would be some sort of a capitulation low, kind of like this, or kind of like this. And it would be some kind of a really deep disruption, followed by a very strong recovery back to the upside. Next, we have the global U.S. to foreign market. And this is something I want to highlight. The foreign market has broken away from a trend. You can see a trend channel here. I'll show it to you on the Smart Cash Index chart. It's broken to the upside. We need to see this hold up. We have not seen this index move above critical highs, although it is moving back to the upside. This is a very strong indication that global markets are finding some support trying to bottom off of this deep, deep low. U.S. markets are struggling right now. They're kind of in a neutral zone. We've had this lower low, which indicates we have a predominance to potentially see more bearish trending. We have seen it move back up. We have taken out a couple of high price levels on the way up. We need to see it clear this high price level, and ideally, ladies and gentlemen, this level becomes critical. If we can get above this level, then I can comfortably tell you that I believe we're going to see upward trending in the markets. But right now, we're in kind of a nebulous, non-trending zone. If I could explain it to you, it's basically it wants to go up. Psychologically, the markets want to go up. There's still some consumer concerns. There's still some Fed concerns. There's still some price unwinding concerns. We need to stay very cautious through the end of this year. Even though I've been calling for a moderate Christmas rally, and we've gotten a pretty good start to one, the reality is we do not have any indication that the market wants to move up right now. It's fairly fragile, and we need to see what happens over the next 4 to 6 weeks, especially with the low volatility through the holidays. So best right now if we just stay solid. It's a totally different world than where we were back over here, although this was prompted by a Fed raise in 2018. Right now, we're really seeing a little bit more strength in the global markets. U.S. markets are searching for a base or a bottom. If we can clear an upside move, and I'll show you on the other charts, then I'd feel a little more comfortable in saying, okay, this looks like it's really moving to the upside. But understand, we do not have confirmation on various technical studies yet. Technology is deeply undervalued. The fear index is low and weakening. The cash flow index is moving upward, but we do not have any real confirmation yet. Obviously, like I mentioned last week, if you wanted to try to dip in a little bit ahead of this, that's up to you. My advice would be to stay safe about it. Execute very small positions, get your toes wet, put some protective stops in place in case it goes against us. But all of my algos and my systems are saying that we are in a neutral sideways trend waiting for some confirmation. Okay, the custom US valuations trend index. This is a monthly chart. You can see again that we're trying to base and bottom here. We do not have any upward trending. We are holding up above this purple line, which is great to see. We're starting to see a little bit of a hook up here in stochastics, but not in RSI. We do need to see this move back upward. We need to see this make some sort of a real strong upward move. For example, this engulfing bullish is a great reversal pattern off of the low. This is what's called a white inside out up. And essentially it's a thrusting pattern. And what we have here is a fairly solid bullish trend off of this capitulation low. And remember, these are capitulation lows. We could see something happen over the next couple days through the end of November to turn this into some capitulation bottom. But it's looking like it's turning into a multiple doji type formation or possible doji hammer formation, which is still indicative of an early stage bottom setting up. But we do not have any real confirmation of an upward trend yet. So that's why I'm warning you. We're looking like early stage accumulation is coming in, and looks like the markets are attempting to hammer out a bottom here. But in reality, we're seeing no real confirmation across various other charts. Okay, next, the leading index weekly chart. This is a very unique custom indicator. It tells us that we are seeing accumulation, but you can see by simply drawing visual lines across here and across here, we're at a very critical juncture. If we get above this level, say up into this level here, then we will have break in numerous trend lines, and we may be looking at a move up into this 260 area, just drawing a trend line across here. But I need you to understand that the reality of the situation here is we're very close to these horizontal downward sloping channels. We could see it stall. We could see it revert. especially if some news happens. I don't know exactly what it would be, but, you know, understand that we are, with China moving into lockdowns, with oil retreating, with gold basing, and with the U.S. markets trying to struggle here. We've seen a nice solid reversion, but it hasn't cleared any of the thresholds that I would want to see to the upside. So, for example, we broke above this high, great. We broke above this high, great. But this is a weekly chart, and we would need to look at unique standout highs. Unique standout high is something like this, or something like this, or potentially something like this, or this. This is definitely a unique standout high. These are little intermittent highs, little unique price highs. This is a standout high, this is a standout high, and this is a standout high because of the amount of time that's separated in between. These are weeks, so understand we've got about 2 months here between this high. We've only got about 3 weeks here, we've only got about 2 weeks here. This is, I would consider, a standout high just because I can count 1, 2, I'm doing the math real quick, 3, 4, 5, 6. So almost a month and a half. This is a standout high because there is no previous high price level for this. So in theory, ladies and gentlemen, we have to get above this level for any real confirmation. This is nominal upward trending. Consider it short-term to intermediate-term upward trending, but we're still in a deeper downside swing. We need to get above this standout high, which is a Fibonacci unique price high, in order to confirm upward trending. The bottom call down here a couple weeks back that I made was absolutely perfect. This is very deep, deep trending, but we need to see some real confirmation of the upside here. We just don't have it yet, especially with this unwinding that's taking place. I can't urge you or even suggest that you consider this any type of bullish, longer-term change of trend. This is really more of a correction in a downtrend. We're hoping it turns into an uptrend. Next, the volume ratio index is showing moderate accumulation. We had the same thing happen back over here in early 2022 and back over here in June, July, before we had the nice little rally. And we get this type of accumulation, like right here, before we start to see some spike in accumulation, then it drops off. So I would expect here we're getting accumulation. We could see an upward move. That's kind of what I'm expecting towards the end of the year. Maybe something very positive. Maybe retail sales come in strong. Maybe oil falls below, say, $72 to $71 a barrel, and we get some reprieve there. Maybe we get some indication that the Fed is going to start to move away from the 75 basis point rate increases, and that would be considered fairly dovish and more adaptive to the scenario in the markets. But it's looking like we're still seeing some accumulation, and I would expect to see one of these spikes, maybe up to 7, 10, 12, up in this area, and that would show you that we're getting to see some real retail capitulation of an uptrend. Right now, we don't have it. We're getting a little bit of accumulation. It's starting to blip higher, kind of like back over here. We need to see one of these types of spikes indicating that we're getting real retail consumer follow through to the upside. Next, the commodity gold index. You can see we had a nice little rally here. This was very solid, okay? Really very solid. Shows that gold is appreciating. Commodities are continuing to appreciate, certain commodities. And we're moving out of that basing bottoming stage like we had back over here. This was COVID. These are previous bottoms, 2018 bottom. You notice that we have to get down into this bottoming stage and then come back out of it to initiate a new rally phase. We've gotten down into this bottom phase. We danced around it, had a little bit of support in June and July, came back down, got deeper into it. Now we're back out of it. This is good. This is indicating that we're starting to see accumulation in commodities, starting to see some sort of an upward trend in commodities, and this will translate into potentially an upward trend into the stock market. We need to see it confirmed, though, ladies and gentlemen. Next, the commodity metals trend index. This is a custom metals trend index. I find this to be a lot more accurate than the actual gold chart. This was highlighted last week. It's another new one. It was up quite a bit last week, up 36%. This is a weekly chart. Sorry, up 36 points, up 0.32%. You can see here we've gotten back into this area that I expected it to stall. I expected gold to come down to 1708 to 1712, roughly, call it 1710 to 1750. I got to 1720 last week, and I believe we still have a little bit more downside in gold before it's going to find its support and rally upward. Now, that pullback was based on the fact that we saw these big, strong upward weeks. I expected it to see some sort of a moderate pullback down into this 618 level, this green level here. That's where I estimated the 1710, 1750 level to come from. If the recent 1720 pullback is all we get, well, fine. I'm happy with that. I still think it's going to likely want to try to come down to 1710, 1750, but if it stalls at 1720 and rallies back to the upside, shooting for 1850, 1860, hey, I'm happy with that too, okay? Because to be honest with you, we need to see gold move out of this consolidation range and really start to set up an upward cycle, which is going to be 1860, 1870, then eventually 1940, 1950, and then that'll put us back up into this area on this chart, and that'll tell us that we're headed back up to 2000. We've really changed direction. So you can see it's looking very positive for gold, but this stalling is just what I expected near this level. It's got to really break above this previous high, which is where we're stalling out right now. So this is going to potentially still try to retarget that 1710, 1750 level in gold. Okay, the FANGs index, basing, bottoming, stalling, looking positive, getting little white bars here. We could see it come back down and retest these lower levels before attempting to move higher. We've broken past this apex level, so we're looking for some sort of volatility to set up. In the long run, ladies and gentlemen, this basing, bottoming down in this area could extend for many, many weeks before we see a real upward trend. So we're not seeing any real solid uptrend in FANGs yet, but we are seeing a very solid base bottom down here, which is the same level as the COVID lows and the same level as the 2018 base. So this looks like it's a fairly solid bottom. It doesn't mean that it's not going to retest some of these lower levels. It could, but we need to see some real capitulation. Like I've been telling you, we need to see consumers re-engage and or some sort of a catalyst. Otherwise, I think it's going to just slide into a moderate upward melt up through the end of the year. Without some sort of a catalyst, some sort of good news, then it's just going to be more of a sideways slide upward. Next, the custom metals index weekly chart. This is the one that's a little bit more tied to gold and silver. It's actually a mix of a lot of different gold and miner stocks. You can see here that we've stalled back out. This was our 1720 low back over here. We are in an uptrend. We have broken this channel. We've seen this little pop. We need to see it find support down here near these lows and move back to the upside. Ideally, ladies and gentlemen, we've got to get back up above like 1825, 1840. That's going to be very critical for gold to move higher, to break away from this downward cycle. And it's very early stage with accumulation. My custom indexes are showing that we have accumulation, but we need to stay away from this lower channel. This 1710, 1720 is very close to 1680, 1690, even 1640 back down here in these levels. We want to see it make a decided move away from those levels. We could base here. This could turn into an inverted head and shoulders. You can see the left shoulder here, the head here. We could get a right shoulder over here over the next few weeks, but ideally we've got to see this get up 1825, 1840 or higher. Then we can start really saying that metals have changed direction for good. Well, temporarily, but away from this downward distribution type cycle and really started an accumulation cycle. Okay, smart cash index. I talked to you guys about this. I wanted to show you the global markets, foreign markets have broken above this channel. They've broken above this support resistance level that goes back over here to COVID. Came very close to these COVID lows. You can almost see the midpoint here, aligns over here off of this bottom. Very solid bottoming. This is a very good upward cycle that we need to see in the global markets, which could propel the U.S. markets higher. But we've stalled out the last couple of weeks, obviously headed into the holidays. We need to see the melt up level and what's going to happen. And ideally, the next level comes into play right here, right around the 157, 156 area. That would be approximately, if I do the math right, about a 12% move upward. We could get up into this area, but by the end of the year, I'm more targeting this area, call it 155 to 160. And that means the global markets could recover, which could move the U.S. markets 7, 8, maybe 9% higher by, let's call it end of the year to January 15th. Maybe, if this capitulates and move higher. If this stalls, then we're going to find real strong support right down here at this level, guys. And that's going to be roughly 130, do the math, 137, 138. So from where we're at right now, that's about a 4 or 5% downside move. And if it cannot find support here, then we will attempt these readdress these COVID lows again. So understand that everything, it looks like an early stage move to the upside, early stage accumulation, but I would expect some volatility going into the end of the year. If we do get that positive news catalyst, we could see it really start to skyrocket, but I'm not seeing that right now. Okay, U.S. Custom Stock Market Index. And this is, again, tells us exactly where we're at. This, you can see the nebulous kind of neutral sideways trending. We're below the dark purple trend channel. We're below the horizontal salmon kind of orangish color line here. We're above this blue channel, upward support channel. We're above the longer term yellow channel. We've come down off of this deep 2% standard deviation and bottom and rallied back up. But we're not seeing a lot of follow through. We've got a good hook on stochastics. We've got moderate upward trending on RSI, but we're seeing no follow through. And in reality, ladies and gentlemen, we're in kind of a sideways flagging formation nearing an apex. If we were to count the basing bottoming formation, so if you were to come down here and try to count this as I've done before, we have 1, 2, 3, 4, 5 ultimate low. Potentially, this could be just wave one of a downtrend. We could be looking at a new uptrend, which would be an ABC maybe move, or an ABC maybe move. But long and short of it, we're in a sideways channel. We're flagging out. We're looking for some catalyst. We've broken through this Fibonacci price amplitude arc. We've broken above this Fibonacci price amplitude arc. We are trying to base and create support. If my interpretation is correct, what we're likely going to have happen is from this low here, an A, B, C, D, E, and that will put us at around January 15th to 20th, 2023, will apex this cycle and potentially move us into a breakout in early January. So we'll see how it plays out. But again, just reading the price patterns, reading this sideways apexing formation, if we are unable to really rally, then we are going to move into a sideways apex flag formation, and that'll put us around January. Well, again, this is weekly, so end of let's call it somewhere between January 15th and February 25th, we will reach the apex and attempt to see a bigger move. Very likely to the upside after we hear what Christmas season is. Remember, psychologically, nobody wants the markets to go down. Okay, there are still hundreds of millions of investors that are pouring money into U.S. markets every month with their paychecks, preparing for retirement, and we've had a very solid unwinding. You have to understand, this is 950 from up here at close to 1370. Do the math. 130 points lower puts us to about here. 130 points lower puts us to about here. So we've seen about a 26, 27% downside correction in the U.S. stock market to this level, unwinding close to 1/4, 27, 28% of total value assets. That, again, if you measure this, 950 down to 600, so this is 9,500. So basically we had a 42% roughly, 45% decrease here. And this was global shutdown. This is a fairly strong unwinding period already. I don't believe we're going to see anything massive unless there's some sort of a massive collapse in the markets. I've mentioned to you this before. That would be wars, global financial crisis, massive pandemic, eliminating, 2, 3, 400, 500 million people. Something like that could send the markets into a bit of a tizzy. But barring any of that, we're going to try to find a base, try to settle, and eventually try to move back to the upside. Okay, custom valuations index is moving higher. I should really address this red line. This red line is just the middle area here. We are moving in an uptrend. I want to point that out. We haven't gotten up above a strong enough level to confirm any real breakout. I will readdress this chart next week, try to provide some more insight. We are not likely going to see this type of appreciation, which was post-COVID appreciation. We are likely going to see some sort of moderate appreciation up into this 50, 60, 70 area, up into this area here, which would be the next phase, which would push the markets to new all-time highs, in my opinion. We are seeing accumulation. We are seeing valuations start to accumulate upward. This is good news. This means that we've already reached kind of an end stage distribution phase, and we're starting an early stage accumulation phase in the U.S. and global markets. We need to see this continue and give us some real solid confirmation of an upward trend cycle. The custom volatility index moved up to 10.27. I had warned you earlier that we could get up into this channel here and still revert back to the downside. So we are positive. We're back into neutral, moderately bullish trending. This is very, very solid for the week of Thanksgiving, but we need to see it really break to the upside, move back up into 11.7, 12.0, 12.2. That would be a much stronger confirmation. But generally, ladies and gentlemen, we're moving back into neutral, moderate, bullish trending right now. We need to see it confirm and continue. Remember, the other charts are showing us that we're seeing moderate momentum, but not breakaway momentum. We're seeing channeling. We're seeing pennant formations. We're seeing lack of consumer engagement. So I interpret this as early stage accumulation, where traders are anticipating upward trending into 2023. But remember, we don't have any real confirmation, so I can't urge you that or even confirm that this is a bullish trend yet. Nothing is telling us that this is confirmed bullish. What it is telling us is we're seeing early stage accumulation in a potential Santa rally. It could turn into confirmation of a bullish trend here fairly quickly. And that's the end of these charts. Okay, so now follow me on Twitter, follow me on YouTube. We're coming up to the end of the year. I want to make sure you guys are aware of everything that's going on. Ask me your questions. Let me know what I can do to make this better. I am making changes to the website behind the scenes. You're not seeing it yet. The MENT.com website will change near the end of this year and early 2023. I am continuing to do research every day to try to help you, and hopefully you understand the value of what I'm giving you every day in these videos or every week. I'm trying to be extremely clear. I'm trying to protect your capital at all times, advise you how to approach the market, how to trade the market effectively, where the cycles are setting up. And by the way, if you haven't followed my S&P or SPY cycle patterns, start following them. They're on the Trade Tank website for you to watch and to follow. They've been really quite impressive. And in reality, I believe we're looking at a moderate melt up into January, February, March of next year. which could turn into a fairly strong rally. But right now, it's just too early to say. Like I said, I don't want to advise you. I'm not going to second guess my models. I'm going to interpret them, and I'm going to rely on what my models are telling us. If we move into an uptrend over the next couple months, we're going to have 2 to 4 plus years of really solid volatility and trending. So we're going to have plenty of opportunity to jump into the trends when the markets tell us it's actually there. But again, share this with your friends. Tell them what I'm doing and explain to them why it's so important to not only just listen to the talking heads out there, but use factual-based data like I'm doing to really see what's actually happening. We're not in an uptrend yet. We're moderately bullish here, which is solid. We're in a downward cycle. You can see these lower highs here. We don't have any real confirmation of an uptrend yet. We're seeing some upward trend in valuations, great, but we don't have any other confirmation. We're seeing upward trend in the U.S. stock market index, but we're seeing lower highs, sideways trending, pennant formation. Very, very dangerous. You don't want to load up onto anything yet because it could break one way or the other on some news. We're seeing foreign markets break out to the upside, then stall. Okay, great. Foreign markets were severely undervalued compared to the U.S. markets. This could be just an early stage reversion. We don't have any confirmation of trending. Gold has done the same thing. Spiked higher, then stalled. We need real confirmation. FANG's index has kind of bottomed and bounced, but it's stalled out. We need real confirmation. We're not seeing confirmation anywhere yet on any of these charts. Commodity gold index has started to move higher. This is the only real sign that I could say that looks like we're starting to see some real upward trending. Accumulation here in the volume ratio chart, but nothing massive. The leading indicator has moved higher. We still need to break above this channel here. I'm trying to draw it for you, and there's a bigger channel up here that comes right across these levels. If we get a big breakout over the next couple of weeks, it's going to be very positive. And it's going to say an early warning sign that the markets are moving into a big, solid, bullish trend. But right now, we're right at that upper channel where it could fail and move back down, try to retest these lows before it moves higher. And that's a very real possibility in December. Same thing here. U.S. valuation trend index stalling out, flattening. Could be a very good bottom. Could be the start of a very big uptrend. Could be the sign that the markets have no momentum to the upside and aren't going to find that momentum until January or February, maybe. So we have to stay cautious. And I'm just going over these. Same thing here. U.S. markets are flagging out off of this upper channel. Global markets have broken through but are stalling. We're getting solid upward trending here, but RSI hasn't confirmed. The tech ratio index is lower, showing techs are not finding any real support yet. Trying to, but not finding it. The custom market timing index and the fear index is weaker. This is telling us that fear is subsiding. Volatility should continue to subside. That's the VIX. We may be entering a new upward trend, which we're hoping for, but we have no confirmation of it yet. And the custom gold cycle chart showing accumulation. The global asset index monthly is trying to find a bottom. Would love to see this start to move back to the upside. That would be a very big indicator for me that we're starting to see some upward trending and some real accumulation. But you can see we don't have that yet. It's still downward trending. And lastly, the large cap index is still downward trending, nearing the end of the cycle. We have about 2 or 3 more months to go, actually 3 or 4 more months to go before we get near the end of the cycle. We could see this shift in February, March, like I told you, but we're still getting very mixed signals with accumulation, early stage accumulation setting up. Okay, hopefully this helps you guys. Like I said, share with your friends. Tell them what I'm doing. I'm trying to help you manage and understand risks involved in the market. This is a pretty good time to maybe consider dipping your toes into some long-term positions. For example, technology, S&P 400, mid-caps, gold and silver, I still think are very good buys down here in 1720, 1730. I mean, I don't think you're going to see those prices again in the next 4 or 5 years. Obviously in the next couple of weeks, yeah, you could see it dance around that area. But 4 or 5 years from now, I think it's going to be incredibly high. Again, we're just not out of the picture yet. If you wanted to start taking some early stage, longer term, smaller investments in technology and other sectors, I do believe this is the right time to do it, barring any catastrophic downside type of move. All right, guys, hopefully this helps you out, and I'm on to the next video.